My name is Kristof Gleich. I'm the President and the Chief Investment Officer of Harbour Capital Advisors. Welcome to another episode of Views from the Harbour, which is our take on what you need to know, what's happening across the world in markets and how it may impact your clients' investment portfolios. This week, I'm delighted to be joined by Jake Schurmeier, who is a portfolio manager and head of fixed income investing here at Harbour Capital Advisors. What makes Jake particularly special this week, although he's special all the time, what makes him extra special at the moment is Jake used to work at the Federal Reserve Bank of New York and has a ton of experience in actually what happens inside central banks, inside the biggest central bank, and has, given his background there and time spent during the COVID crisis, what crisis management looks like as well there. So we're going to pull on all of those threads at the moment. Really extraordinary week in markets, one of the most extraordinary I've seen in over 20 years of being involved in markets. So Jake, welcome.
Thanks for having me.
What is going on is question number one.
The short answer is a lot that we can see, but not a lot that we can understand. And so what's happened over the past week is we've had 3 bank failures in the US. So the first one was a smaller San Diego-based bank that had some crypto exposure. Everyone kind of rubbed it off as, this isn't systemic, this isn't kind of a major issue, it's very idiosyncratic. So that was Wednesday. They announced that they'd wind down their operations, a pretty small bank. By later that day, actually, Silicon Valley Bank, a bank with around $200 billion in assets at its peak, announced that they'd be realizing some losses on their available for sale securities. They'd also be trying to raise equity in order to kind of shift their balance sheet to be more resilient to rising interest rates, as well as shoring up their capital base as they were seeing deposit withdrawals. By Thursday, the equity raise failed, and there was soon a run on the bank as depositors, which were largely tech-focused firms, started to exit. And so by Friday, in the middle of the day, the FDIC took over the bank and placed it in receivership. So the bank failed. Over the weekend, we get news from the regulators on Sunday evening that another bank is taken into receivership, so Signature Bank of New York, and the regulators and the Fed announce that there's going to be a systemic risk exception for those 2 banks so that uninsured depositors are made whole, whereas traditionally only deposit amounts below $250,000 are protected. And the Fed, as an accompaniment to that, also announced a new bank term financing program that would supply banks with funding in exchange for securities in order to kind of alleviate some of these mark-to-market loss issues.
And that's the BTFP, correct?
Exactly.
Yeah.
Exactly.
And then Signature Bank, that wasn't a small bank either. That was pretty. I think that was the 3rd largest in history with SVB. So we've had the 2nd and the 3rd largest. Okay. And then we've had continued volatility going on this week as well, certainly in fixed income and in the treasury markets. You've seen a massive repricing of interest rates, and we've seen some more regional bank equity volatility. So talk a little bit about what's going on this week before we even kind of get to today's events.
Yeah, so as you said, there's been a lot of just volatility writ large, but in particular, people have focused on regional bank equity stocks. And so you've seen some regional banks down as much as 60-70% over the week. And so that's because the market's kind of moved on to, okay, what were the vulnerabilities embedded in Signature and Silicon Valley Bank's business models such that it caused them to fail? So, markets have been focused on, do you have a lot of losses on your available for sale and your held to maturity asset side. So you have to realize some pretty significant asset losses to your net income in order to make deposit withdrawals. And on the deposit side, they've been focused on what is your insured versus your uninsured deposit base to try to get a sense of how sticky are your deposits.
Mm-hmm.
So amidst all of that volatility, we've seen a number of statements from the various regional banks saying, varying degrees of, we've had some deposit outflows, we haven't had that much, we've seen some inflows, some interest. So there's just been a lot of noise, but not a lot of signal. And so the only signal we really got about what's actually happening under the surface in terms of deposit churn is today we got the H41, which is the Fed's weekly balance sheet release. So this is the Fed's own balance sheet. And as part of that,
let me just pause you there. So lots of noise, lots of headlines, but there is definitely some signal kind of within that. And this H41 report, which we're going to talk about momentarily, is significant. It's a weekly data release from the Fed that 99.9999 recurring percent of the population don't care that it exists. But at times like right now, it's really important. And there's also another one that you're going to talk about. I know that we've been speaking about over the last couple of days, the H8 report, which comes out on Fridays as well. So if our listeners are hearing more and reading more about the H41 and the H8 and thinking, where do these come from? This is why they're really important. So go jump straight in, Jake, please.
Yeah, so the H41 came after the close today, Thursday the 16th. And so what that gave us was a glimpse into where the Fed's balance sheet stood as of yesterday. And so what we learned is the Fed has about $300 billion in additional lending outstanding relative to what it had last week. About 10 or so of that is from this new facility, the Bank Term Financing Program. About 150 billion is from the discount window. So that's the traditional way the Fed lends to solvent banks. And then about 140 billion or so was a line item that was a bit confusing at first, but it's for the FDIC for the uninsured deposits that they guaranteed for Signature Bank and Silicon Valley Bank. So you can think of that 140 as kind of the bank failures gone by, and the 150 is for existing solvent banks who are borrowing to get financing from the Fed.
So the Fed's balance sheet has expanded by 300 billion in the past week as a result of them kind of being a lender of last resort and having to step in and stabilize this crisis. Is that approximately correct?
Yes.
Okay. And how do some of these measures can help us contextualize some of these, the sizes of them? Look, we all go back to 2008, the last financial crisis. We all hope that would have been, a once in 100-year storm. But help us kind of juxtapose where are we today with kind of 2008 as a comparison? How is it similar? How is it different? And then just what have you learned from this H41 report in that respect as well?
Yeah, so I think in terms of the volume, the peak of discount window borrowing during the financial crisis was around 110 billion. So clearly we've surpassed that. I think a key difference here, though, is I imagine there's a lot more encouragement and hopefully less stigma around the discount window this time. And the reason being is, as part of the announcement of the BTFP over the weekend, the Fed also changed the terms and collateral terms and haircuts associated with the discount window. So the discount window is also much more attractive to your marginal borrower than it was last week. And so hopefully that associated with, reducing stigma is encouraging these smaller banks in particular to start to draw more from the Fed's discount window.
Got it. And then in terms of the question around 2008 more broadly, it's very different. Like each crisis has its own kind of unique features. And I think one of the big differences, in 2008, there was a credit problem, systemic credit problem, and there was kind of balance sheets impaired, left, right, and center. And it was very much a self-reinforcing cycle. And asset impairment and write-downs leads to more asset impairment and write-downs leads to bigger balance sheet holes, and it feeds in on itself. At least here it's not a credit issue. Some of the banks had, if you like, an asset liability mismatch from a duration perspective, but it's less about kind of an underlying credit dynamic. So there is distinct differences. We don't think we're going to go through another 2008 here, but this is definitely something that we're watching very carefully. So HF1 surprised a little bit, I think, by some of the size of the numbers around the discount window, and maybe the BTFB was a little bit smaller than maybe you thought, but the discount window and the expansion of the Fed's balance sheet may be a little bit bigger overall. And then let's finish on the H8 report, which is coming out at the end of this week. What are your expectations there? What are you going to be looking for when that is released?
Yeah, so the H8 is the weekly balance sheet of banks. So it has all their assets, liabilities, etc. And it also splits it out between large and small banks. And so we'll get that tomorrow after the close. Unfortunately, though, it's as of the prior week's Friday. So, we'll get some of the initial issues with Silicon Valley Bank, but we won't get kind of the full picture. But it will be kind of the first point to kind of benchmark for next week's data. I mean, the other thing we learned today was FRC, a large regional bank whose stock price has been under duress in recent days. They also put in an announcement after the close, basically talking through what's happened with their balance sheet. So talking about their deposit outflows, generally saying they still have a large share of the insured deposits they had prior to all of this volatility. And then they said they were borrowing from the discount window in pretty large size, and they took about $30 billion in wholesale deposits from a consortium of other banks. And so these are the JPMs, the Bank of America, US Bank Corp. I think there's around 8 or 9 banks in total that together put in about $30 billion in deposits into FRC. And so hopefully, and based on the market's reaction so far, this is giving the market some assurances that all of these other large banks have skin in the game, because ultimately what this week may do, and what regulators in the banking system writ large are worried about, is if you're worried about uninsured deposits, this might incentivize you to go to a larger systemically important bank. And that could be problematic in the short run if that adjustment happens very quickly.
Yeah.
Because as banks are seeing deposit withdrawal outflows, they're either going to the discount window to finance those, or they're selling assets. And if everyone's selling assets, that can lead to a lot of volatility and some credit issues down the road.
And it's the announcement today by the consortium of banks was a liquidity injection rather than a capital infusion. Is that correct?
Yes, that's correct.
Okay, so look, the situation's very fluid. We're going to keep focusing on this as long as we need to, but I don't think this is going to go away as quickly as it came and presented itself. It's going to take some time to work through. We're going to keep looking at the really important data. Jake, you mentioned, maybe just finish up. We've created a crisis dashboard. Kind of what are some of the indicators you're looking at? Like, why is a crisis dashboard to help you and us navigate through this?
Yeah, so we're looking at things like discount window borrowing. We're looking at the change in money fund assets. So all else equal, a bank deposit is pretty substitutable with a money fund deposit, asset. And so we're seeing large growth there. We're looking at things like FRA OIS spreads.
Meaning money going into money market funds.
Exactly. We're looking at market-based measures like FRA OIS spreads, kind of where repo rates are trading relative to the Fed's target range. Other indicators that could give you some glimpse into whether banks are having to pay up to get funding. So are banks experience actual funding needs beyond the kind of unknown, which is deposits moving around the system? And that data really is at the behest of the individual banks. So we don't have a good sense of where deposits are moving other than kind of in aggregate through the H8 data. And that's the data we'd really want to have.
Follow the deposits. Jake,
exactly.
Thank you very much for joining us. That concludes this week's episode. We'll be back with more on this unfolding market situation. But I hope everybody's well and you all found that informative, and stay tuned for more. Thank you.